last saw the cash rate hiked in November 2023, and I think it's been the fastest hiking cycle since the late 1980s, early 90s. We've seen the cash rate just jump up since May 2022 up to this level at November 2023 and holding here for now a year. And in fact, households have really been struggling with the weight of that level of cash rate. Data from Rate City says a complacent borrower with a $500,000 loan balance today could be paying a mortgage rate rather of 7.1%. But if you shop around, haggle or try and get a better deal, maybe refinance, some of the lowest variable rates are 5.75%. In fact, 34 banks have cut at least one variable home loan rate to under 6%, according to Rate City. And you can see there that for the last 12 months now, households have been weighted with that 4.35% cash rate. So certainly pays to shop around, according to Rate City. But I have in the studio with me now Ivan Colquhoun, the Chief Economist at Creditor Watch. Ivan Colquhoun, thank you for joining me. No surprises today, but you were flagging that markets have underpriced the chance of a rate rise. Why?
Yeah, I just think that the inflation trajectory for the underlying rate, which you mentioned in your introduction, just hasn't been declining quite as quickly as the RBA expected. And with employment being quite strong, there was a slight chance. Now, obviously that hasn't happened. It was a much higher chance than a cut today. I think the board is still saying that underlying inflation remains too high. That's a little bit of a change in that first headline from above target and proving persistent. So perhaps they are happy with that progress. They are making some progress, but not rapid progress at this point in time. And of course, the good news is the labour market is still very strong and employment has been growing strongly. So that's part of their mandate, but getting low inflation is also a priority, and they keep saying it's their number one priority.
And you mentioned the employment market. That probably has been the standout in terms of strength, because the economy is experiencing very tepid growth, but the unemployment rate's at 4.1%, which historically is very low.
Yeah, it is. And I think sometimes we all focus on rates of growth, but sometimes levels of activity are very important. And if you look at GDP, it's quite a long way above where it was before COVID. If you look at it in nominal dollars, so just the dollars you and I spend, it's a lot higher. Spending is a lot higher. Profits are a lot higher for businesses. So I think that's part of the story as well. Even though we're not growing as quickly, activity is at a high level, profits are at a high level, and that's keeping the economy quite robust at this stage.
And I'm just looking at the statement briefly that accompanies the RBA's decision, and of course this will be very closely read, more than I have time to do, but the board says it's still not ruling anything in or anything out, and that's been a key line. It says policy will need to be sufficiently restrictive until the board is confident that inflation is sustainably moving toward the target range. I mean, that reiterates some of what was in the previous month's, the September statement. What does that tell you about the board's thinking? We certainly haven't seen a turn in the type of communication, and there's no easing bias there yet.
No, and sufficiently restrictive. Remember last month they did two scenarios, one where they had to become more restrictive, another one where they could become less restrictive. What they're saying is at this stage they haven't got that sufficient confidence that inflation is tracking towards target. I've just quickly looked at their forecasts. Their forecast has unemployment slightly higher at 4.5% through 25, so that's up 0.1%. That's hardly any change. They've reduced their inflation forecast for trim mean to 2.5% at the end of 26, so that's a little bit better. And their growth rate, GDP growth, has been moved down a little bit. So both of those the bias of their forecast is towards a little bit more chance of rate cuts coming through, but it's going to take some time. They have to get that confidence, and they didn't get that with the last CPI.
So when do you think that move will come, if it is indeed a cut?
Yeah, look, it's most likely still to be a cut. I've been thinking February, but the latest employment numbers made me think that that's at risk, and as you said, market pricing has pushed that back. So I still think first half of next year it's likely, but we shouldn't be holding our breath for a lot of interest rate cuts in Australia, and we shouldn't want a lot of interest rate cuts either, because
that signals the economy is not going well.
Yeah, so some moderate interest rate cuts through next year, through the first half, I think that's likely.
And of course, apart from the RBA meeting, the big policy event, if you like, or political event is the US election. Is a Trump victory more inflationary, or is a Harris victory more inflationary? What's your outlook there?
I think markets and most economists think a Trump victory will be more inflationary. Tax cuts, also tariffs, which obviously push up prices. No real plan to reduce the budget deficit. So I think, and possibly even a change in the chair of the Federal Reserve. So markets expect it to be more inflationary under Trump. But under both markets, the big sell-off in bond yields is in part because markets expect both administrations, whichever it is, not to really tackle the deficit and not to really, be particularly anti-inflation.
Yeah, so US debt's probably not coming down too much regardless. Ivan Colquhoun, thank you so much for your time. So Jane, as you heard there, households shouldn't hold their breath for rate cuts anytime soon, according to Ivan Colquhoun, and also the commentary from the RBA statement so far. It does look like any rate cut that we're going to get is going to come next year at the earliest.
All right, thank you for that update, Alicia. Well, let's go back to David Taylor, who's outside the RBA. David, my sincere apologies for having to cut you off so quickly last time, but you have the floor now. You've been having a look over the statement from the Reserve Bank. What are the key points?
Look, Jane, for me, the story here is that you've had 13 interest rate hikes since May of 2022. That, of course, is designed to bring aggregate demand back down. It's designed to basically stifle the economy and to bring inflation back to the target band of between 2 and 3%. Now, that simply hasn't happened. There's been progress on inflation, and indeed headline inflation is back between the target band of between 2 and 3%. But core inflation isn't. Core inflation is still above 3%. And what's really interesting is that anyone who's renting or perhaps has a rundown old car or a chronic disease or struggling with all sorts of sticky price hikes, they're going to know and they're going to feel inflation acutely. And rent is one of the biggest ones, and the cost of building a new home, again, is another big one. They're not going away. They're coming down ever so gradually, and the Treasurer has been at pains to point out that sticky inflation has ever so gradually come down, especially over the last 6 months. But it's not at a point that the Reserve Bank would be comfortable with, and that is between 2 and 3%. So in the statement, the Governor has gone out of her way to say we are still, in quotes, vigilant to upside risks, and she's still, and the board and her are still not ruling out anything, in or out. So a rate hike, staying the same, or a rate cut. Something could come from left field, of course, and that may have something to do with the US election or geopolitical risks, and of course a rate cut becomes obvious. But at the same time, do we need to see, and we don't want this of course, but do we need to see the unemployment rate move up in order to get aggregate down to the point and demand in and around the economy to the point where that core inflation does come down to where the Reserve Bank is comfortable with? But I'll just say this and try and ram it home, that the Reserve Bank of Australia needs to be confident that core inflation, the inflation that is smooth and pushes out all those volatile items, it needs to be confident that that type of inflation is going to stay between 2 and 3% into the medium and long term. And Jane, at this point, it's not.
All right, thank you, David, for that analysis. Now, the rates decision has been reverberating here at Parliament House, and during question time, the Treasurer, Jim Chalmers, stood up to provide his reaction to the rates decision just a short time ago.
Those opposite gave Australia much higher public debt and much higher student debt. And this side of the House is giving Australia much lower public debt and much lower student debt. We think lower public debt and lower student debt is a good thing. We know now from the reaction to our announcement on the weekend that you think that lower student debt is a bad thing. And so let every young person and everyone in Australia with student debt understand this side of the House is trying to cut your student debt. That side of the House wants you to have more student debt. Millions of Australians. He wants to have more student debt. Now, Mr Speaker, I can hardly believe my luck being asked by the Shadow Treasurer about public debt. Because since we've come to office, there has been $150 billion less public debt because of our responsible economic management. And because of that $150 billion in less debt, Australians will pay $80 billion less interest on that debt. And if those opposite were still sitting over here, Australians would still be copping it in the neck when it comes to those higher debt interest repayments, Mr Speaker. Now, because we've been able to deliver two surpluses, not an outcome that those opposite are familiar with, because we've been able to improve the underlying cash balance by $172 billion in 2 years, the biggest nominal improvement in history, because we've been able to do that, we've been able to see much less debt than what was forecast by those opposite. And what that has meant, as I said a moment ago, is when you manage the budget responsibly, when you manage the economy responsibly, you can make room to support people who genuinely need our help and genuinely need our support. And on this side of the House, our Labor values tell us that responsible economic management is important. It is the bedrock of a good government like this one that this Prime Minister leads. But it's not an end in itself. Responsible economic management is not anathema to helping people who are doing it tough. It's central to it. It's crucial to it. Because by cleaning up the mess that those opposite left behind, we've been able to give a tax cut to every taxpayer, an energy bill relief to every household, and cheaper medicines, cheaper early childhood education, wages growth, rent assistance, cracking down on the supermarkets, and most importantly, in the context of the last couple of days, making sure that Australian young people, and particularly students and graduates carrying student debt, that they can earn more and keep more of what they earn. We know that you don't want them to do that. We know that you want Australian students to have more debt and graduates to have more debt. We're getting public debt down, we're getting student debt down, two things that you are either unable or unwilling to do.
And that was the Treasurer Jim Chalmers there responding in question time to this interest rate decision. The RBA has left rates on hold at 4.35%. Let's go back to our business team and Alicia Barry. That was the political reaction there from the government. What's been the reaction from the market?
Well, probably not surprisingly, Jane, it's a fairly muted reaction on the market because this decision was widely expected. We're seeing the ASX 200 index down 0.4%. It was down as much as 0.5% today, so not too much of a bounce back at all. And as for the Australian dollar, it has lifted slightly to 65.9 US cents. It was sitting at about 65.8 US cents or thereabouts. But no doubt traders will be heavily scrutinising and reading very closely the Governor's accompanying statement to today's decision and interpreting that as they will, and that may in some time move markets. But as for right now, the market has delivered a fairly muted response, not surprisingly.
All right, Alicia Barry, thank you. And now for your final observations, back to business reporter David Taylor. I can imagine it might be a fairly muted response from Australians who might have been holding out a glimmer of hope of some sort of interest rate relief too.
Well, it's funny you should say that, Jane, because I was planning on giving millions of mortgage brokers a glimmer of hope, and that is that if you look at the way the financial markets are, if you're looking at the way that the financial markets are looking at this, the money markets, they track, the short-term money market tracks all the intricacies of the Reserve Bank, as do international markets. And at the moment, a rate cut by the Reserve Bank of Australia is what's called fully priced in by June of next year. So the thinking is that the Reserve Bank has its forecasts correct and that core inflation, what I was talking to you about before, will gradually subside, and by the middle of next year, Jane, the Reserve Bank of Australia, it's expected, will be confident enough to make the first interest rate cut. Let's hope that happens.